Hi, folks. Welcome to the Weekend Investing Daily Bite of 30th of July. Please read the disclaimer fully and understand it, and then move forward in the video. Today, we're going to talk about three ancient wisdoms on money that you should apply right now. So, we'll talk about what has been passed down in our culture in terms of how to deal with money. So, what if the real secret to enduring wealth was not about the latest market trends? I mean, that is the main focus that we have day in and day out. That what is the trend right now, and what is the trend tomorrow, and what is likely to happen. But in this world of constant market fluctuations, how do you build wealth that truly lasts? So, this building of wealth, sustaining of wealth, is a much bigger, uh, I wouldn't say a problem, but a situation to tackle if if we are thinking really long term and wealth creation. So the answer is in timeless old money concepts, very very powerful principles from India's ancient wisdom, and we will unlock some concepts today that are deep rooted in our heritage and that can really transform your financial future with a bigger picture in mind. Actually, let's dive in. So, this first wisdom is that money is earned by luck and lost by stupidity. So, in India, there's a strong belief in the bhagya or fortune. Many successful ventures attribute initial breakthroughs to being in the right place at the right time and meeting the right person. And how true is that? If you look at the journey of any successful investor, entrepreneur, business person, it it almost always starts with the fact that that person was there at the right time at the right place. It was just by luck, whether it was the biggest of entrepreneurs or the biggest of even successful career folks. It was just a matter of first getting very lucky in terms of your starting point, at least. And it could be anything, but small examples. A small kirana store owner also could experience this, and he had a small store, but a new residential complex came next to his store, and that created a boom for his business. Or an ancestral property was lying somewhere for a long period of time, and suddenly a national highway came along near that property, and the infrastructure developed and the ecosystem around it developed, and it became a multi-bagger. So it isn't about passively waiting because you don't know what's going to happen, but about recognizing and seizing opportunities which luck can present. On the other hand, stupidity is the reason why most of this earned wealth gets lost, or murta as we say. Impulsive, ill informed, or overconfident decisions usually will result in wealth destruction. So, examples of that could be investing heavily in get rich quick schemes. When you see the social media, uh, X, YouTube, Instagram, everywhere people are basically enticing you, Telegram, enticing you to come in and get rich within months. Somebody is doubling your money every month. Somebody is going tenfolds every year. So not having that basic knowledge that money doesn't grow like that. So investing heavily in get rich quick schemes is a sure short way of losing whatever you or your family may have built over a very long period of time. See, wealth gets built, almost like a one step at a time, and you go slow in terms of building over a like climbing a staircase. And when it has to come down, it comes down like an escalator or even straight jump from the building. Dubious multi-level marketing program. This is another one where a Ponzi scheme sucks in folks where you are building a MLM program, and in your own mind you think this is the next big thing that is happening. Blindly following market tips for unverified sources or speculating heavily with leverage, taking debt, excessive debt for lavish weddings. I mean, these are all examples of just plain stupidity to lose your existing wealth. The real wisdom here is that getting rich might start with luck, but staying rich takes smart choices, self control, and avoiding big mistakes. And when I deal with a lot of HNIs and people with wealth, I find that none of them are running after returns. All of them are very focused about, are we properly diversified? Are we properly asset allocated? Are we having full trust in the person who we are giving our money to or following our money with, the entire focus there is not returns. Yes, they also want market or market beating returns, but that is not their first principle. Their first principle always is my money secure? Can I trust the person I am putting my money up with? Am I going to be reasonably protected from wild market fluctuations? And all that means that you may have to give up some returns for achieving that, but that's fine with them. So that's where the old money concepts come through. You'll talk to any old money family and look at a new money person or a family and see the difference in the investment approach. They're like poles apart. Second, money is an amplifier. So money doesn't change you who you are at your core. If you are a nice person and you get significant amount of money, you will do a lot of nice things to others and to the society. If you are not such a nice person, that will also amplify. So more resources and opportunities will basically amplify your inherent nature. So positive implication is person with generous heart and community spirit, once he is able to acquire more wealth, will expand philanthropic efforts, build schools, fund healthcare, start NGOs, help their close circles at least. Negative implication is people who love to show off will spend more, will get rich, unsustainable living, financial disasters, over leverage, and doing all those kind of things. So this is basically how money will amplify who you are. So the key is that a person will basically become exploitative or selfish or oppress others or engage in corrupt practices, accumulate power for personal gain, and that will continue to go up, 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 up. So the wisdom there is that before accumulating wealth, at your core principles, when you are building the blocks of your career or your life, it is crucial to cultivate strong values and character. Values and character don't come with money. Money will amplify whatever you have. So money will merely make those values, good or bad, more visible and impactful. Third principle is to avoid lending money. Old money families often refrain from lending money, especially to friends and family, to preserve relationships and to avoid family complications. And I have personally, I don't know if I can call myself old money or not, but I have never encouraged this idea of doing lending between family or friends. I think any business done with family or friends can result in a poor outcome of that relationship, because financial markets lending can often lead to uh, outcomes which are not in your control. Somebody takes money from you, invests somewhere, or does whatever with that money, not able to come back. That relationship changes. So, udhar within family and friend circles is very common in the Indian mindset, and this can lead to significant friction, breaking of bonds when defaults occur. And you only have so many people around you who you can say are friends and family. So the shame associated with asking for repayment also is immense. The other person may be shameless in not repaying you, but even you will find it very, very difficult. So why avoid it? Because first of all, you are having an opportunity cost. So lending at zero or low interest rate means losing out on potential gains of your own money. And there is really uh, no obligation as such. Yes, you would want to help the person, but there are ways in which you can help. uh, of course, there is risk to relationship, as I mentioned, and risk of loss, that the money will never be repaid. So you will be you will basically not feel so good about it. The alternative approach there is that if somebody is truly in need, then you can either give them some money. Maybe if they're asking you for 5 lakh rupees for whatever, starting a business or something, make them go to the bank, make them lend from a proper institution, and support them with some money, which in your mind can be gifted away. That is, you are prepared to lose that in your mind. In fact, you should write it off in your mind, and if it comes back, it comes back as a bonus. For larger sums, professional arrangements with clear terms of collateral are preferred. So maybe if you are able to do a proper contract with collateral, that probably is going to help both sides. And bonus point here is invest in learning. This is a very big one. A lot of times when people make significant amount of money, they forget that we live in a changing world, and The most valuable asset is not just the accumulated land, property, gold, stocks, whatever it may be, but knowledge and wisdom, which you need to constantly upgrade as you go along. So there needs to be a consistent investment in learning, not just with money, but with your time. So prioritizing learning will give you that edge. That continuous learning is crucial for staying relevant. You'll be able to identify new opportunities, so you'll be adaptable to the current environment. You'll be able to make informed decision making, so learning provides the tools to make intelligent decisions. And it is a game of personal enrichment also, so beyond financial gains, your personal life will get enriched and it will broaden your perspective. So if we just sort of look at the key takeaways, if somebody is truly in need, old money wisdom suggests luck might start your wealth, but smart choices keep it growing. So you will have to attribute it to luck to get started, but of course you need to keep trying. Money shows your true self, it doesn't create it. Value your relationships and your money, and the best investment is in yourself. This is the key takeaways from this topic. Tell us in the comments how you like this topic and what are your views about it. Did you know or follow any of these ancient habits with your personal journey? And if you like this content, you may also like this video that I've just linked here. Please click on this 5 lessons about momentum investing, and we'll basically now move to the market section. So what happened in the markets? Please do like and subscribe the channel. My daily request to you. Nifty moving up 0.14%. So Nifty, after coming back yesterday, staged a slight recovery further. The market is waiting for the Fed's outcome tonight. So that is 30th July tonight for India time. And while the Fed is not likely to change rates, um, they may talk about the coming 2 quarters plan for that, or they may give some indication of what's coming in terms of interest rates, and that is going to be the big one in terms of moving market. If there is an indication that there may be 2 cuts, 1 cut, 2 cuts this year, I think that will help emerging markets and India to move up. Nifty Junior absolutely flat at 0.08%. Mid caps also almost flat, 0.18%. Small caps down 0.1%, almost always also flat. Nifty Bank also not going anywhere. So market was completely sort of waiting for the next move. Gold is moving up 0.5%. 99.25 is where gold is per gram. This time the gold dollar price has not moved up. It is still quoting around 33.25, 33.30. But the USD INR is moving up very sharply. So in just the last 2 or 3 sessions, we've gone from I think 86.3 to 87.4, and that is a very big move. And that too, especially when we are bracing for any rate cut news. So any rate cut probably is going to strengthen the INR, but here we are weakening, and it can only be attributed to the fact that perhaps market is discounting the tariff of 20-25% that is likely to happen in towards the end of the year, and all hopes of the tariff settlement, I think, are out of the window as of now. So it's very perplexing, this move, or maybe the RBI is trying to signal something and letting go of the price it was holding on to. So while most people were expecting the rupee to strengthen in the last few months, it has gone absolutely the other way. And at 87.4, I think we are very near an all-time high on the USD INR. Advanced decline ratio, you can see completely flat, 244 to 256, so even both ways. L&T made a big move up at 4.85% in the Nifty, and Tata Motors made a move down at 3.45%. Other than this, there were not any major gainers or losers in Nifty. In the Nifty next 50 space, big moves in DMart, Britannia, VBL, and LTIM. Down moves in Motherson, Swiggy, Canara Bank, uh, DLF, and PNB. In the movers of the day section, you can see that DMart suddenly spiked up from nearly 4,000 yesterday to 4281, 7% up. This is on new stores announcement. So they are, I think, opening up 11 stores in the coming times. And that is a big move coming up. Although at every level, most value experts say that DMart is crazily valued. But from a liquidity perspective, yes, liquidity has moved in to DMart today. Tata Motors, on the other hand, moved down big on Italian truck maker acquisition news. So, $4.5 billion or some figure like that is going to be spent in acquiring stake in the Italian truck maker. I remember when they first acquired JLR, Tata Motors made a huge down move, and the similar kind of a move has come today as well. So Tata Motors, which is down like crazy from its all-time highs, is moving further down. It seems on this news. Sectoral trends: real estate again getting beaten down minus 0.96%, media down 0.8%, PSU banks 0.6%. Autos, very surprisingly, but maybe not so surprisingly, down 0.6% on 30th of the month. So it means that auto numbers coming out on the first are expected not to be so great. Capital market also down 0.3%. What moved up? Minorly, Nifty infrastructure moved up on the basis of L&T results and the order book for the next year. L&T was doing very well in the markets today. Nifty IT also some recovery here, 0.3%, and the others were not very meaningful. These were some of the real estate stocks getting beaten down: Brigade, Oberoi, DLF Prestige, and Godrej. You can see the chart looks not so good at all. After five down moves, there was one sort of dead cat bounce, and again it is beginning to move down. Real estate minus 0.96%. This is another video that we did recently, which you may want to watch. So do click this and watch this, and let us know how you like this content. Do subscribe to the channel. Do share this channel with your friends and family, and I'll see you in the next one. Bye.